favorite mid-cap banking pick, Federal Bank has rallied close to 25% in the past year, outperforming Nifty and Bank Nifty that had single-digit negative returns over the same period. Now, Q2 FY23 performance was full of fireworks. Record net profit on the back of strong loan growth, expansion in interest margins, strong support from fees, moderation in cost-to-income ratio, and a further improvement in asset quality. The steady expansion in ROA and the guidance on further improvement in ROA as well as interest margin despite firming up of rates is reassuring. The slack in deposits was a slight point of bother but remains largely an industry-wide phenomenon. The question now to look at is if the stock can re-rate further. Asset quality remains pristine with slippage to NPA down to 375 crores, lower than the guided range of 400 to 450 crores earlier. Recovery was also healthy. Consequently, gross and net NPA declined to 2.46% and 0.78% respectively from 2.69% and 0.94% in the preceding quarter. The overall stress book stood at 1.9% of average assets versus 2.6% in the year-ago period. The bank expects significant reduction in its restructured book by the end of the current fiscal. Credit costs perked up to 53 basis points from 41 basis points in the previous quarter as the bank improved its provision coverage on NPA by 250 basis points sequentially to 69%. It also carries excess provision on the restructured book. Advances growth gained momentum with YOY growth coming in at 19.4% with strong traction from retail and wholesale segments. Federal Bank appears to be gaining market share. In addition to the strength seen in traditionally strong areas of mid-market, gold, retail and corporate, the bank is making progress in new high-yielding businesses such as MSME, CV, CE, credit cards and microfinance. The good news is that despite the strong growth, risk profile has not worsened, as evident from the benign risk-weighted assets to total assets ratio of 59%. The bank saw a further improvement of 8 basis points in net interest margin to 3.3% in Q2 and now expects the full year interest margin to be at 3.3%, which is 5 basis points higher than what the bank guided earlier, indicating a further uptick in interest margin in the quarters ahead. With 65% of the book in floating rate, the bank saw margin expansion riding on the improvement in yield on advances despite the rise in resource cost. The bank is guiding to a stable interest margin with the return of pricing power even in a rising rate regime. Now, this remains a key watch. The all-round improvement in earnings resulted in an expansion in return on assets to 1.2% from 1.1% in the previous quarter. Given the strong earnings visibility, the bank now expects Q4 ROA to be 1.25% and for the full year to be at 1.2%. With revival in economic activity, not only has lending firmed up, but fees have also started gaining traction. In Q2, core fees rose 45% year-on-year and lent strong support to non-interest earnings. The strong growth in interest as well as non-interest earnings coupled with strong cost management despite network expansion resulted in a steep decline in cost-to-income ratio to 49% from 53% in Q1. With 66% of employees under the defined contribution pension plan, the drag because of employee cost would incrementally wane. While business growth is robust, deposits have lagged for the entire system and Federal Bank is no exception. Deposits have grown 10% year-on-year lagging credit growth. Even sequentially, credit growth of 6.2% is ahead of deposits growth of 3.2%. Consequently, credit to deposit ratio has shot up to 87% from 80% year-on-year. The ratio of low-cost CASA has also been stagnating around 36% of deposits. While a retail-centric deposit base and prominent position in NRI remittances is positive for Federal Bank, it remains to be seen how the bank capitalizes on the same to garner resources at competitive rates. It's also riding on its fintech partners to mobilize deposits. With steady expansion in ROA, the earnings trajectory looks exciting. As of now, the capital position or resources should not stand in the way of its growth journey. In the context of the strong earnings outlook, we see immense value in the stock that is still trading at a reasonable valuation of 1.1 times its FY24 estimated book. Now, of course, some key risks to watch out for. One will be the severe impact of economic slowdown on earnings and asset quality, and or the inability to garner deposits at competitive rates, resulting in margin contraction.